Well, tēnā koutou katoa, welcome all to the news release for the official cash rate. The headline's already out, and as you know, the official cash rate remains at 1.75%. And we expect to keep the OCR at this level through 2019 and into 2020. As always, there are risks both upside and to the downside. Risks to the downside to our growth projections, upsides to our inflation projections. And as always, the timing and direction of any future OCR move remains data dependent. The pickup in GDP growth in the June quarter we saw was partly due to temporary factors, and business surveys continue to suggest growth will be soft in the near term. That's over the second half of this calendar year. Employment is around the maximum sustainable level. However, core consumer price inflation remains below our 2% target midpoint, and that necessitates us providing continued monetary support. GDP growth is expected to pick up over 2019, assisted by the monetary stimulus and population growth, underpinning household spending and business investment. Government spending on infrastructure and housing also supports this domestic demand. The level of the New Zealand dollar will also support export earnings. As capacity pressures continue to build, core consumer price inflation is expected to rise to the midpoint of our target range at 2%. Downside risks to the growth outlook do remain. The weak business sentiment could weigh more on growth for longer, and likewise trade tensions continue to remain in many major economies, and that raises the risks that trade barriers could increase and that can undermine global economic growth. To the upside, with regards to inflation risks, higher fuel prices are boosting near-term headline inflation. We will do our best to look through this volatility as appropriate. Our projections do assume that firms have limited pass-through of these higher costs into generalised consumer prices, and that longer-term inflation expectations remain anchored at the midpoint of our inflation target. We will keep the OCR at an expansionary level for a considerable period to contribute to maximising sustainable employment and managing low and stable inflation. Thank you very much for listening, and I'm open to questions. Before we start, I want to note that we've got Jeff Bascan, the Deputy Governor, and we have John McDermott, the wisest man in the Reserve Bank, our Chief Economist, here.
Governor, your statement has taken out the reference that the next move in rates could be up or down. Are you taking a rate cut off the table?
No, we're not taking a rate cut off the table. I think it would be pointless to do that, to remove an option. What we are saying is that we are very data-dependent, data-driven around how our projections unfold. The risks to the downside remain, the global risks in particular, and also domestic investment activity. Likewise, the risks to the upside are evident to all as well, with the cost pressures and margin pressures that are on businesses.
And would you still describe yourself as neutral in the same way that you said last time?
Yes, I would describe myself as data dependent.
Just quickly on your inflation profile, that looks a little firmer than it was previously, and yet you're still saying you're going to keep rates where they are for well into 2020. Can you perhaps explain that a little bit? Why would you keep rates where they are if inflation, you're expecting it to be firm?
Without doubt. So, near-term consumer price inflation is and will be higher than, and in fact, we are projecting it to go above the midpoint of our target. That is near-term CPI inflation, and we always have to remember not to spook ourselves by things we anticipated and expected. We are now amongst that. If you recall, 6 months ago, we said these higher oil prices will feed into near-term higher CPI inflation. Our challenge is how much of that will be carried on through into core underlying consumer price inflation, and we are still sitting there with the view that with GDP around its potential, we need to lift that core inflation pressures up further from where we are, and that's why we're maintaining that stimulatory monetary policy.
In your last MPS, you also said that the Reserve Bank was data dependent, and I think the one before that as well. But today, you said that was one of the reasons that you removed that phrase of it could be up or down. But if you were as data dependent as you were in August, as you are today, I mean, I just want you to kind of go into a little bit more about the rationale for removing that, if the reasons are the same.
I like to think that we don't need to be anchored to exactly the same words each time, and I do want to say that we really do need information from the financial markets around how they are pricing and seeing the risks as well. If all we're doing is looking at a mirror of ourselves from the short end right out through the full bond yield curve, then what is the information base of financial markets? Why are they being paid? So we are very comfortable around our inflation target. We're very comfortable around the midpoint pressures on that. We remain data dependent, as do all the forecasters and anyone buying or selling long-term index instruments.
And just on yesterday's unemployment numbers, how much of an impact did that number have on your monetary policy calculations today?
Too early to tell, I think, is the saying. I have to say we've really welcomed, a decline in unemployment. I would say it has helped confirm what we've been hearing from businesses. This quarter we spent a lot of time out, the whole team were from one end of the country to the other, and businesses talking around the table were quite different to how some of the headline surveys were filled in. This very low business confidence, this declining domestic demand expectations that were in the surveys was not really what we're hearing around the business tables. They were talking about far more about capacity pressures and margin pressures, and in particular the labour market. This kind of helped make better sense of squaring the circle on that picture.
Governor, what's your sense on why those capacity pressures and skill shortages don't seem to be flowing through yet to significant wage inflation?
Yeah, so a couple of thoughts there. One is after a long period of low and stable inflation, expectations do get dampened and fixed, and that is certainly in our projection framework. John, might want to just elaborate on that around what we've been doing with the inflation expectations and feed through.
Yeah, absolutely. It is a fundamental question. There's an old cliche in monetary policy that things work with long and variable lags, and so the key part of the question, I think, was yet. And just going back to the overall strategy, picking up a few threads of the questions. We cut interest rates back in 2016 with the intent of increasing demand above supply within the economy, both for goods and services and employment. Eventually, that increase in demand over supply would drive the inflation rate back to the midpoint. And we said, well, that's going to take roughly 2 years. That's the transmission mechanism, plus or minus a few months here or there. And so what we've been seeing with the unemployment rate and the increase in activity is what we hoped to see. That was what the plan was. And along that, we could stick to that plan as long as prices would be fixed towards the target. And as we monitor, so Adrian has picked up on inflation expectations, both 1 year, 2 year, and even 10 years are a little bit higher. They've sat pretty firmly around 2%. So eventually, firms think prices will increase on average across a range of goods and services at about 2%. And that's what we wanted to see. So this is, in terms of the outcomes for monetary policy, is pretty as good as it gets, really. We had a plan and it's working.
And we have been very positively impressed with how the labour cost index has been mimicking or mirroring the CPI index through time, and that's probably the most accurate measure of like-for-like jobs on wage pressure. We do have to remind, I think, a few people as well, is that we are comfortable seeing capacity pressures rise because that's what we are trying to do, get core inflation back towards the midpoint of our 2%. So, part of what we're observing is a necessary part of monetary policy.
The jobs numbers yesterday showed, or appeared to show, that the capacity of the economy maybe was a bit bigger than some have forecast, which has been a pattern for a while. Does it make you question your own forecasts about the capacity in the economy, and are you potentially increasing that?
Absolutely it does. I mean, the measures of capacity, you know, they're broad approximations of an abstract concept measured to 2 decimal points. So, you know, we're constantly searching for measures of where we are relative to that. We've spent a lot of time, as you well know, looking at the GDP relative to trend measures of GDP, the output, and we've always had a significant band of uncertainty around what that level is. Likewise with the labour market, I mean, it's fascinating just how many indicators there actually are of labour market capacity pressures. So some are definitely, you know, showing signs of being beyond maximum sustainable employment. Others are about on average, and some are still below, you know, around desires of wanting more work or able to work, not yet looking, these types of areas. So we always have to be aware of the approximation of these tools that we're using.
So it doesn't bother you to have been significantly out in your forecasts of growth, inflation and unemployment over the last 3 months?
I would say that we're within the usual bounds of uncertainty, and I would also like to just probably step back from that assertion, Brian. Let's look at the big picture here. We've got low stable inflation and we've got one of the lowest unemployment levels in the history of New Zealand, so are we that far off?
It's probably worth adding, 'cause I think you asked, are we bothered? I think the developments are extremely welcome. It's what we were hoping to see. And if it's come a little bit earlier, well, so be it, and all well and good.
Sorry, just Jeff, you talking about just the standard errors around those household labour force surveys and just the volatility?
Oh, well, I mean, I think the trend picture has definitely been a labour market that's tightening. And as we've been discussing, we expected to see that. One gets a bit hesitant about, you know, jumping to the precision of a particular number. You know, unemployment's measured with a sample error, I think, of around 0.5%. So, you know, if all of that was exercised, this number would have been pretty close to what we expected. It's at the upper bounds, but yeah, the trend picture is the labour market's improving, and as the Governor said, underlying in wages is also gradually lifting in line with underlying inflation. So the headline number is not showing a lot. It's bounced around a bit by one-offs, but we think there's a gradual pick-up and in the way that we expected.
Kia ora. How much of a risk do you see to next year's GDP forecasts from pessimistic business confidence? And would you consider a rate cut if those GDP forecasts are not met?
Rate cut. So, you know, you're looking at our best estimate, so our midpoint estimate, and in that sense we are discounting the very low negative business confidence, but it still sits there and weighs on our thinking. I'd say the bigger, you know, and that is particularly around business investment. I said before that businesses should invest, and then I got told off because that sounded like I was providing instruction. What I meant was they should invest if they have still strong demand, they can't find the labour and they need to build more capacity. And that is about the capital building, capital deepening that you would generally see at this point. Some of that is happening according to our business discussions, and you can see it through the import figures as well. They remain very high. So that business investment we've got as a positive growing thing in that forecast rather than negative. One of the other areas, I think, and where we're really challenged with, as always, is what consumers are doing. In our forecasts, we actually have the savings rate starting to improve, which is always a heroic assumption for a New Zealand economy. And I think they're just saving less. So, in other words, that consumption is actually just matching income rather than all expected future income. So we have quite a conservative consumer growth area in there, and I would put that as one of the bigger risks. You know, just how realistic is that compared to past behaviour?
I think one of the themes that we're just having in this discussion is how much you weight what we've seen in the last few months versus what we anticipate over the next 18 months, 2 years. And you know, what we've been buoyed with is, you know, a more positive picture for the last 3, months than perhaps we were anticipating. But we've still got those risks on the horizon when we look out over the next 18 months. And that's the uncertainty, and that's the reason why we're saying we're sitting and watching. Will the business sentiment translate into weaker demand? How will world developments go? Will we see those capacity constraints actually flow into wage costs and prices? So we've got to look ahead, and we're expressing some uncertainty about that as we look ahead.
And so if GDP falls a bit short of those forecasts, whether it be because of business confidence or consumer spending or international risks, would you consider a rate cut?
Yes, is the answer, which is why I mentioned before, why would I take it off the table? You know, that's, you've got to remember only 6 months ago, everyone was telling us, why haven't you done it already? Look at the global economic growth, look at the trade wars, so on and so forth. And so why remove that optionality, given the uncertainty that exists?
You've said in your key policy judgments that you expect the Kiwi Build program to add to the rate of house building from the second half of next year. You know, this year we've only seen, I think, 18 houses built, 18 more by the end of the year. The last ANZ Business Confidence Survey showed residential construction intentions falling off a cliff, effectively, and the construction industry saying that it's at capacity and it's struggling to add to that capacity. So what are you seeing that's suggesting that Kiwi Build can actually add to what is already a construction industry at capacity?
It is, I mean, it's a great question, and it is an incredibly complex story in there, isn't it? Around, you know, we've got construction firms that are struggling to make profits, we've got construction firms who are fully stretched, we've got resources being challenged. So that is one of the challenges to the Kiwi Build program. Are they simply substituting out for houses that may have been built anyway, or are they building in addition? And if so, where and how are those resources coming from? So again, we see the shade of it. The exact parts, we haven't gone to the full extent of the build. We've assumed some minor set-off.
Yeah, we've discussed extensively with our colleagues at Treasury who have got some of the fine details, and we've largely taken on board that information. And you can imagine when one you know, important part of the economy starts to increase demand, it will actually crowd out some other parts. But overall, I still think we'll see quite a lot of activity over the next few years in residential construction, either from the private sector or the public sector.
You know, on the flip side, it may well be wonderfully timed. You know, net immigration declining, people, you know, building booms are through, they may well accidentally land in a sweet spot. That's just yet another alternative.
But John, you mentioned a lot of activity, but what does a lot of activity mean? Does that mean the government's going to meet its Kiwi Build targets?
That's really not for me to say, but it does mean that, you know, the builders will be fully occupied. I assume that they will try and increase capacity by taking on labour, training labour. You know, and if that fails to materialise, look, what we'll do is alter prices within the economy. And again, so our forecasts are predicated on what are the demand on resources and what does that do to prices. So either way, that pressure will lead to the type of outcomes that we're looking for.
And we have that sitting in our risk space. You know, one of the risks is that fiscal policy can't be spent as quickly as is penned at the moment. That sits as a downside risk. But, you know, certainly as part of our core forecast, we're saying they've said they're doing it, they're doing it.
And we expected it to ramp up slowly. I mean, it was in the previous forecast rounds, we postponed the pickup because we knew it was taking longer to establish the program, to get it the institutional capacity, if you like, to do it. Exactly how fast it picks up is uncertain, as we said, but it was always going to be more next year than this year and more the year after that. And that's what we hear from the agencies involved.
Just further on that, I suppose, I know it's not for you to say if they will meet the targets, but I suppose what must play into your thinking is, you know, the construction industry being at capacity now, that's 30,000 homes a year. Kiwi Build wants to add 10,000 to that, so 40,000 homes. Mm-hmm. And the difference between those two numbers must play into monetary policy quite a lot. So you must have some indication or must be thinking about, you know, whether the 10,000 houses they build are in addition to 30,000 or whether they build, you know, 10,000 houses and the private sector builds 25,000 houses. You know, how far does that 10,000 houses take away from existing construction capacity?
No, exactly. Fair point. Yeah, And again, we're not privy to all the details in the plan on how some of the constraints will be moved. And I think some of the big things is availability to land, there's some relief of credit availability. All that will be extra demand over and above what would have otherwise have taken place. But I think it's also fair to say when you put pressure in the system, some of that pressure will be felt by the private sector, and they will be crowded out to a part. So we've taken a partial increase, if you like, and something that would fit with historical records, and our Treasury colleagues, well, actually, they've basically informed us about the kind of numbers we should be taking on board inside these forecasts, and they seem very reasonable.
Governor, do you think 1.75% is enough of a buffer, enough room for the Reserve Bank to respond if, in the next couple of years there is a, some sort of global recession or a recession that you need to respond to?
Yeah, well, it's kind of an endogenous question, really, isn't it? It depends on the size and what the shock is. Certainly around just some of our core forecasts, and we do a scenario where global economic growth does prove to be weaker, some of the types of, and impacting on the domestic GDP, and that provides us plenty of room to be doing behaviour, but another GFC.
If memory serves, I could quote you chapter and verse on this, but when Alan Bonner cut from 8.25% to 2.5%, the question arose, well, why stop there? I seem to recall a response along the lines of that the lower bound for New Zealand might actually be higher than zero, for reasons I can't now recall. Would you give any credence to that view?
I would, no, I wouldn't, and really what I'm just thinking about is I don't really know how to even come at that. I mean, we run monetary policy, you can do what was called, what they call it, non-normal, unusual, unconventional monetary policy, which actually used to be conventional monetary policy, where you print notes and coins and dish them out on the streets. So we just happen to use the interest rate as a pricing variable at the moment as a means of doing it. Back in the 80s, it used to be money growth supply. There are many tools, and we have actually produced a very good bulletin article just earlier this year on what those tools are and where some of the bounds may be on those things, but it's certainly not at a 2.5% nominal OCR rate or a 2.
Probably just worth picking up on that point. You are going back in history a little time. I think the issue at the time was we thought 2.5 was about what was needed. And to try and experiment beyond that, there was concerns about relative interest rates, particularly against with Australia, and what would that do about New Zealand's ability to attract the needed capital during the global financial crisis. Of course, had the domestic conditions needed it, we would have used monetary policy appropriately. So, but I don't think we ever said that 2.5 was the lower bound. And then Adrian did point out that there is a really good bulletin article that we put out a few months ago that highlights what Plan B would look like if it was ever required, and we drew on a lot of international experience, in terms of QE and other experience, and then what a New Zealand flavour of that would look like, particularly how we could utilise the swap markets in particular, which is quite liquid.
Governor, here. So speaking globally about uncertainties. The U.S. midterm elections, I just wondered what your thoughts are on how this bank and other banks would react, or whether this would be a consideration going forward.
Well, probably the only certain thing I've heard so far, or claim to be certain from it, is that a wall won't be built between the US and Mexico, because they needed both houses, I understand. But even then, I couldn't confirm that. The real challenges there are not too dissimilar to New Zealand, but obviously a lot larger. They've had a fantastic run-up. The housing market's done what it's done. Consumers have done what they've done. Household debt is back, at good levels. How much more juice is in the tank? And in between time, what are we doing? What are they doing with regard to the global trade battles that they're having? So, there was an enormous amount of concern, I would say, at the most recent IMF meetings that we attended around the global risks. And I have to say, I'm amazed how quickly that has disappeared off the radar from New Zealand discussions. Some people talk about us as this, kind of like Wilson, the ball bouncing around in the ocean, and the ocean's pretty rough at the moment. But it's an interesting story because the core central forecast for global economic growth is still in that 3.5% to 4% growth range, depending on whether you're talking the US and excluding China, etc., which is very positive growth. But the bounds around it are very, very wide, and people are mostly biasing them to the downside in terms of the risks. And a lot of those risks are the ones that manifest very quickly. You know, one of the big challenges that are happening at the moment is that through the US trying to tighten their policy because of how loose they were, it's actually making financial conditions tighten everywhere else in the world, almost other than the US. Because as interest rates rise in the US, capital is flowing out of many of the emerging market countries back into the US, and it's their markets that are finding it tighter at the same time that they are struggling on the trade front with the rise in tariffs. So how does that manifest itself, especially for a country like New Zealand, who is more dedicated to a very wide range of trading countries on the way through? So that sits there as a core risk, but something that is almost impossible to model.
Is that risk amplified by the fact that global debt to GDP ratios are all-time highs?
Very much so. Yeah, and that is, the number one concern, which is, of course, the IMF stands for it's mainly fiscal, and they are sitting there looking at these very stretched balance sheets again, both within China, in particular amongst the banking sector and the public sector, and then within the US across the household sector, and they are very nervous about where is the fiscal room, because they know the monetary room is a lot less than it used to be, and the fiscal room was their lender of last resort. Where is it this time? And so there's a lot of discussion again about making sure that people are ready, people have liquidity, people are thinking hard about long-term access to capital on these types of areas. So that was the main conversation and dialogue. Very little talk about central paths for economic growth. It was all about the tail risks and how they manifest.
Governor, it's the figure A2, distribution of internal OCR advice. I hadn't seen one of those before. It only goes to 2016. What does it look like this year?
So the reason we're producing that is, John?
Yeah. Look, the future's going to look a little different. Assuming that the current bill that's being discussed gets passed, that there will be a committee, so the market will have to get used to different types of information. One of them be, should it ever be necessary? I mean, sometimes you get to a consensus easy, sometimes it's not so, and there will be votes. So this is the type of information, should it be required, that you would expect to see. And it's kind of, so not to muddy the waters with current policy settings, what you've got is some historical settings, right? It's kind of safe. But the reality is that advice that's being provided is by senior people within the organisation who don't have any legislative responsibility for making decisions. So we just want to make that clear, that this is just the type of advice that we talk about and that gets presented, often in written form, to the governor. We're going to a world where that's much more formal. So it's sort of advertising about what the future looks like.
Well, was it a unanimous set of advice for this decision, and was it unanimous, say, 3 months ago that you should?
I would say it's been highly debated around how we put this together. The central forecast is strongly owned by all.
I think that's a really important point, because there's lots you can debate about the starting point, where the activity is, what's really required in the medium term for monetary policy strategy, and the last part is, well, what do you physically need to do with the official cash rate?
And as an advertisement for the future,
yep.
Subject to bills passing houses, etc., we will be operating under a monetary policy committee of 4 internals. If I get my way, you're looking at 3 of them, and 3 externals. And we will be publishing the minutes of that, and I would hope that that truly reflects the breadth of discussion around, like, how much crowding out, what's happening with inflation expectations, is that a fat tail risk on growth? So you get more of that richness of flavour. If we don't get a consensus, we will vote, and you will see that vote as well. So
what was it like having Gabs McCloof attending the meetings this time around.
Wonderful.
And were you surprised that he will be the ongoing observer?
No, I mean, if with the Treasury Observer coming on board, you want a very senior person to be anchored there. The challenge, I think, for the very senior person from Treasury is balancing the diary, because once our dates are fixed, as you well know, they remain fixed. So it's going to be quite an operational challenge to have the Observer there. But great to be able to just chat about the fiscal policy situations, etc., and think, you know, just yet another sense test. We've also always had a couple of external people from industry, and they've been providing great insight. We've had two new people come in, William Rolleston and Susan Patterson, and bringing, you know, really strong perspectives and fresh perspectives on business activity, making us use less jargon. That's always a good challenge for us economists, and doing that. So we're wide open for a very wide, diverse set of views coming in.
Just the last one on this. Earlier in the process, the Reserve Bank opposed the Treasury having an observer. Went so far as to say they can attend but not observe the final decision-making meeting. I mean, what's changed? Well,
I think the observer status is, well, what's the change is it's not our decision how it's run. I mean, the decision is that of the government, so they've made that choice. The observer status has been much better understood, and there's quite a significant, I think we even published it, the hoops you have to jump through to show you're non-conflicted and what you can and can't do with the information, etc. There's the operational challenges that go on. So, you know, a lot of that detail has now been understood and put to bed. It wasn't as simple as just walking across the road and saying, "What's up, mate?" You know, it is quite a complex situation. And I will also say, you know, let's wear our heart on the sleeve here for a minute. Operational independence is critical for a central bank. And so anything that feels like it might be starting to be threatened, of course, is going to be strongly defended. So, you know, we've got the belts and braces in there for now on the way through. Have I said enough on that, Jeff?
I think so.
Are you saying that you do think there's a risk that your independence is being eroded at all with these sorts of reforms, particularly the Treasury Observer?
No, I don't. But just because I'm not paranoid doesn't mean they're not watching. You know, just keep a really, really good idea and outlook for that, because we know what the alternatives look like. But by the way, independence is about, you know, having the confidence you will make the right call based on the purpose that's needed. But it's also meaning that you've got enough confidence in mana to really look for a wide set of advice in making that decision. And so, you know, independent doesn't mean isolated. We need to make sure we get that balance right. Otherwise, people call for legislative reviews, don't they?
Just back on the "it could be up or down" reference being taken out of the statement, you said that you aren't particularly wedded to a certain way that statements are worded. Does that mean that this phrase could come back in, say, the next monetary policy or OCR statement?
Too early to tell.
But it could?
Yes, it could.
Right.
It's in the realm of possibilities.
The New Zealand dollar's come back up recently to 3-month highs. Would you like to see it lower to support exporters?
No, I have no view on the currency in terms of levels. It will do what it does. The way we think about it, the economics profession, is it should reflect relative prices, productivity adjusted between countries, and miraculously that's what it's been doing. So it has been surprisingly well behaved. As soon as I say that, it will probably become unbehaved. But, you know, it really is moving to relative demand, relative inflation pressures between countries at the moment.
Just asking about how the banks are lending into the economy and households. In Australia, the changes about capital rules and lending practices seem to have had an impact on the housing market, and their prices are falling over there. Do you think that over the next year or two, any change in bank behaviour after the report this week, and any changes in capital requirements could factor into, you know, how keen they are to lend into the economy and therefore affect the economic growth outlook?
I would love to live in your world, Bernard, where they're thinking very, very hard about the long-term sustainability of household balance sheets and lending accurately to make sure that those are well understood, well received, and we have an optimal allocation of capital through time. And that optimal allocation is not just housing, but it's across into wider business. At the moment, we're heavily banking dependent and heavily dependent on the housing sector for their banking. And so it's, it is a concentrated sector without doubt. Our projections are for house prices just to continue to moderate, and so we're kind of painting the Goldilocks scenario there, where house prices growth slowly moderates as income continues to grow, and we see some of that leverage coming off. And that's exactly what's been happening for the last 12 months in a nice, sustainable manner. Of course, houses are asset prices, though. They're subject to emotions and all sorts of other shocks. So we will watch that. And it's interesting, that's the kind of, when we're balancing that risk, I talked about the consumption, a big part of consuming. Well, I think John tells the story, we're consuming $1.10 out of every dollar of income for much of this last 15 years. We're now spending about $1 out of $1 income. So, we are actually less reliant on future expected wealth as we're consuming. So some of that pressure's on its way out. And hence we've got consumption growth reasonably constrained in the model. Coming forward, though, as businesses have been telling us and as households, there's huge policy uncertainty out there across both what we may or may not do, how banks may or may not behave. Likewise for the tax working group coming home, bright line tests for tax, upgrades for what a rental actually has to look like, these types of things. So, it's a harder market.
I might just add that we've been seeing, household credit growth around 0.5% a month. We're pretty comfortable that that's, more in line with income than it was before. It's moderated. We've seen some evidence that banks' serviceability expectations, the way that they judging a household's ability to finance or repay mortgages have tightened a bit, probably in response a little bit to Australian parents and Australian influences. It's definitely not a credit crunch. But it's moderate, reasonable credit growth, I suppose, is the way I describe it, and we think that's more in line with what we were wanting to see from a financial stability perspective. We've long talked about trying to get credit growth in line with income growth, and we're feeling more comfortable about that.
So are you planning to ease the LVR restrictions later this month with the financial stability?
We're assessing that, but the information I just talked about is obviously pertinent to that. Now we're looking through a range of considerations, the levels of debt, because we still have high levels of debt, the exposure there that the governor's talked about, but the conditions in terms of the way the market is and the lending's playing out looks like those risks are moderating. So we've just got to weigh up the pace of that moderation against the levels issues, I guess.
So you are considering easing the LVR?
Oh, it's part of our consideration. We promised to look at that each FSR, and that would definitely be explicitly considered in the financial stability report.
And will we have an outcome in this November 28th?
You'll have a decision whether we are or aren't changing it. And what we're really hoping to move forward to as well is just a more regular forward path that people can see what we are doing with the LVR. So probably more normalising it along the OCR type space where we can
decision-making
framework so that it's not like a mystery, when are we going to turn up and do something. People will be able to see a timetable.
Because if you do release it or relax it, you could see another surge of lending going out into the market, a bit like the one with that little easing, was it the end of 2016, 17, when it seems to have been a factor in the growth in provincial house prices.
So, yes, these are all the things we have to weigh up on the way through, just whether that would be an outcome or whether it be an outcome we would be comfortable with or not on that side. Just to bring it back, we're really looking at bank credit growth and the balance sheet side. That is the critical part. I believe that the LVR is still a constraining factor for some banks. We think, well, where would it go if we aren't the constraint?
And especially given on the Bank for International Settlements data, New Zealand's household debt to GDP ratio is higher than average for advanced economies. Shouldn't that be a factor?
It certainly is a factor, yeah, without doubt. I mean, we've got
mentioned the level of debt. You're right.
We've got some real specific challenges, that are unique to New Zealand that we keep reminding people why we have a home regulator and insist on local incorporation and insist on specific capital levels that may be different to where you came from. We're also highly exposed to just the banking sector, housing market debt, in a small country that has many, many different risks. So that's exactly what we need to line up. We don't want to have to be doing it on our own. We need to have the whole industry thinking that way.
Just finally from me, on the tail risks that you mentioned were discussed at the IMF, what are the ones that you're most focused on that would affect New Zealand the most over the next year or two?
I think pretty well. This is me talking personally. We've got a whole. We love to worry, and there's a whole list of worries at the end of Chapter 2 in the document there, with ups, downs, will remain the same across those sides, and any one of them is material on the outlook. Probably the real fat tail one in my mind is just if long-term bond yields rise for the wrong reasons rather than the right reasons, i.e. markets get spooked, start to demand a lot higher price for capital outside of anywhere other than the United States. And that is the type of balance sheet, sudden one-off 100, 200 basis point impact on balance sheets that lead to all sorts of very negative outcomes. So, we need to continuously be stress testing our banks, their funding ratios, their core liquidity, their capital ratios against those types of scenarios. What keeps you awake, Jeff, other than your golf handicap?
Yeah, hard to sleep with that. No, I think those financial conditions and ultimately if a trade war escalates, which is very hard to know where it would go if it went up right into the severe realms of possibilities. We're a trading nation, commodity prices get impacted. It's hard to see that we'd do favourably, notwithstanding some of the models seem a little more comfortable about that, but to be honest, I can't see that we'd do well as a small trader.
And if you want to add to the worries, I mean, Adrian has started worrying about the financial channel, but that could easily be amplified domestically through a confidence channel. So you see the news offshore. It's not relevant to New Zealand, but a few minutes later, it's very relevant.
Okay,
So is it those sorts of tail risks and worries? Is that the reason why the OCR track is still the same, despite the fact that the picture that you are seeing is better than you expected, improved sooner than you expected? I just find that confusing.
One, the optionality of being able to cut versus being able to rise, why would you ever remove that? And I'd say those tail risks do weigh heavy. The second part is we have to remember core inflation is still below the midpoint of our target. And again, it was only 6 months ago that they were saying, what has the Reserve Bank been doing? How come we're continuously below the midpoint of the target? Have you been not doing your job? So on and so forth. So we're here to do our job, and we think we still need to have that stimulatory behaviour. The GDP figures are part noisy, and we talk quite explicitly about that. We've looked through some of the upside on the GDP number and smoothed over the quarters, but we're balancing that against the business confidence and all this other near-term world we live in.
If I can just ask you to put your bank regulator's hat on for a second. The Australians have imposed a levy on their major banks, and there's calls here for a levy to be imposed on banks here. Have you been asked for any input on that, and or do you have any thoughts on that?
Not asked for input, and no, I don't have any thoughts on it.
And also, there's talk about filling the regulatory gap around forcing banks to report on their conduct and culture. Do you think that there's a conflict for the Reserve Bank having the dual roles of being a bank regulator, if they do have to enforce that, and also around financial stability? Because obviously if you're forcing banks to report this stuff, which might actually be quite negative.
Yeah, I mean, it's a fascinating question. Just really quickly, most of the regulatory, potential regulatory gap is actually with the Financial Markets Authority, not the Reserve Bank. We're very comfortable with our powers and purposes around the prudential regulatory side, our ability to reach into the banks, our ability to extract what we need to extract on the way through. So some more of it was just related to having some actual kind of teeth to enforce some behaviours if it hasn't come through other methods, i.e. the use of sunlight and consumer pressure. In the conflict, you know, we write the financial stability report every 6 months, and I just wish we'd been more firm. Sometimes, looking back through history, it is a document about saying, hey, are you aware of these risks when you turn up and deal with this financial institution or that sector or whatever? So we are continuously and always flagging the risks. Getting people to read it and then behave on the back of those is the continuous challenge on the way through.
So does that mean we're likely to see FSRs which are actually more explicitly critical of the banks?
I believe that's already happened. You know, we've got our real-time financial dashboard, which immediately, real-time, you can see what banks owe what to who, by how much, and that is a world first, a global first. And I know that a lot of bank board members themselves are busy flashing that up on the screen during bank board meetings, having a look at the opposition and competition and saying, why are we different? Is that good or bad, etc. So that's already creating that type of interest. We were very, very challenging, you know, in the past around the levels of bank capital, very, very exercised around making sure they improved their core funding. When I was last here at the Reserve Bank, I think 90% of core funding for banks was 90 days or less. Now there's a much longer reach into it, so continuously doing it. We've been waving the flag on household debt, on dairy farmlanding debt, you know, continuously out there saying, these are the flags we are seeing. Are you sure you understand the product and the activity that you're entering? So.
But if you've been continuously critical, it doesn't seem to have had that much of an effect on improving bank culture and conduct.
I know that you've read the conduct report because you were sitting with us at the press conference the other day, and I think that you'll see that we didn't find anything kind of widespread poor conduct. We did see activity that needs investment and improvement, and that's what we'll be talking about with the banks, and that's what I'm talking about at FEC soon after this, on the things that we need to be seen done. By the way, it's not just the banks. You know, let's also remember that people actively and willingly choose to go and use the banks. It's the wider public and the business community that need to wake up as well on the way through. Asset prices don't always rise. Interest rates don't always fall. The exchange rate doesn't always stay just where they want it, so on and so forth. So, you know, we're trying to appeal to a wider audience with our financial stability reports than just talking to the church of the converted.
I think it's been an evolution in financial stability thinking over the last 10 years to see conduct risk as one of the greater risk factors. And we're doing that. I mean, I was just this morning reading an article about hundreds of millions of dollars of conduct risk losses to banks around the world, and it's been associated with a lot of the crises and scandals in one form or another that banks have not managed these risks. So we're making sure it's on our risk register. It's appropriately in our risk management discussions with boards and senior management. We're focused on it, and you know, it's pleasing that we haven't got acute issues at this time as per the review, but we want to keep it that way, and we will keep it on our risk scanning and appropriately part of that.
Cool. All right. I'd like to thank you all very, very much, and good luck. Thank you.